So we're going to talk about options trading. So what is an option? Basically, we need to understand that. So if you look at here, the options is a derivative financial instrument between two parties. So basically, what really happens is you contractually agree to transact an asset at a specified price before a future date. So what it really means, there are two types of options basically. So that is call options, and then you have the put options. Okay, so basically, so when you're talking call options, so you have the right, or you are in obligation to buy the shares at a certain price, the strike price which you mentioned. So basically you have the right to basically buy those shares, so at the current price, so 100 shares. So that is your call options. When it goes by the put option, as you can see here, we'll be discussing all these things. So if you're taking in account what is the put option, you have the right or the obligation to sell the 100 shares basically. So before we discuss what is the call options in detail, so about what it is, bullish strategy, simple, it's a directional bit. I want to just directly take you to the terminal on Thinkorswim platform, as you can see here. So we'll be discussing a few terms, that is basically we need to understand what this terminals, what we are looking into basically. So if you look at this, that is if you look at this, I'll just take out another. Yeah, so if you can look at this, so what is this? This is something called what we call as option chain. So this is something called option chain, as you can see here. So basically what really happens here, what we need to understand, that we are taking a company called Microsoft, that is MSFT in ticker name. So it's a company, as a software company, very renowned, everybody knows, it's worldwide famous. So right now the shares of Microsoft is trading at 295.02, 294, almost at the range. Let us take at 295 as it is current market hours. It's in trading in real time. You can really trade the options basically in this current time. So what I need to make you understand is that there are three terms that is one need to understand, that is in the money, out the money, and at the money. So basically now we need to understand. So the left hand side, what we'll be looking at is the call options, and the right hand side, what we'll be looking at is the put options. So now we need to understand what is at the money. At the money is something which is trading at 295, that is almost 294.75 or 295. So you can just say this strike price, whatever comes in between this price range, so that is at the money, so around this level at 295. So right now we are focusing on the call option here, and we need to understand that what happens in a call option. Basically when you're buying a call option, you want the share price to go up. Okay, so in that scenario, what happens, your strike price goes from out of the money, it goes to in the money, in which you make a profit out of it. So we'll come to that more in details. So we need to understand what is basically in the money, out the money right now. So if we take the strike price at 295, that is at the money, so whatever strike prices are above 295, as it is at the current price, so whatever that price is, so towards 300, 305, 310, 315, 320, 325, 330, so all this range are what we call as out of the money. So, and vice versa, if the strike prices are below what we choose, that is below 295, that is 290, 285, 280, 275, and so on towards the below side, then we have in the money. So this is out of the money, this is in the money. So out of the money and in the money, to be clear. So this is for the call option. Yeah. And now towards the right hand side, if you look into this, then we have, this is something called put options, right, of the option change which you are buying. So we know that this is at the money going on around this level, that is 295, as you can see here. So in the put options, you have the right to share, you have the right to sell 100 shares at the current strike price. So basically what really happens is that whatever we discussed with the call option, so it goes the reverse way. So if the strike price is, if we take it above 295, then it becomes in the money. Okay, and if the strike price is above 295, that is 290, 285, 280 and so on this side, then it will be out of the money. So this is for put options basically. So this is for put options. Now we'll be discussing about call options. As we know, so if you're buying one call option at a certain strike price, you have the obligation or the right to buy at that strike price of 100 shares. So basically that's that. So it's a directional bet. So what it is a bullish strategy. So if the stock price goes above the strike price, you make money. So that's the thing. It's very simple. So it has a net debit upfront cost. So when you're buying an option, a call option, so basically you have a net debit, that is you have an upfront cost. So you have an upfront cost, then you have the maximum risk is limited, so downside is limited, as we'll be discussing about that, and the maximum gain is unlimited. So if the stock price goes up and up, so basically you are going to make a profit out of it till the expiration of the option. So we can look at the break-even point with a little bit of calculation here. So break-even point is when the price of the underlying security, that is equal to strike price plus the price of the option. So profit calculations, maximum side, as we said, it is unlimited, and the profit is made when the price of underlying security is greater than strike price plus price of option. So as I mentioned that in a call option, we need the stock price to go up in order to be profitable. So that's the thing. So the price of the underlying security, that is a ticker which will be trading, so that needs to be greater than the strike price or the price of the option. So profit per option owned is price of underlying security minus the strike price plus the price of option which you paid in order to buy the option. So the risk calculation, that is the maximum downside, so we'll be looking at that is the maximum loss is limited to the premium paid, that is a net debit. So when you will be buying that option, so maximum loss is made when the underlying security is less than or equal to the strike price. So let us take an example to understand the long call strategy so much better. So as you can see here that so the potential outcomes at the point of expiration, so we'll be showing that. So what is the outcomes of the call option is that a strategy. So so we will be basically it won't be necessarily we'll be using the exact prices of these options, so we need to be aware about that, and we will be ignoring the commission cost. So let us take this example of the initial trade. So the company X is stocks trading as $50, as you can see here, and you expect it to increase in value. So the share price will increase in value. So that's your research which you have done. So at the money call options on the stock X stock, the company X stock, that is the strike price of 50, that are trading at $2. So this is the thing, it is trading at $2. So you purchase one call contract, that is of 100 shares, for investment of $200, as you can see here. So if your contract will be worth, basically if the company share price increases to $52 by expiration, so what really happens is you reach the break-even point. So you could exercise these stocks to buy either 100 shares at $50 each and sell them for a profit, or to hold on to them. But you see, even if you buy at $50 and sell at $52, but you are still paying $2. That is $2 into 100, that is $200 in one option contract of one call contract. So that's why you get a break-even point. But if the stock X increases, the company X stock increases to $55, that is, the stock moves more further up. So if it goes more further up, so basically what we can see is that your stock price at $55 will be roughly $500. But you see, your initial investment of $200, you see, will that will make a profit of $300, that is 500 minus $200. So you could either exercise them or sell them just before expiration for a profit. So this is the profit side. And if the company X stocks falls or does not increase by expiration, so if it stays the same, your contract would it goes towards expiration, that is, it goes worthless in the expiry, and you would lose your initial investment. So what was your investment? So investment was $2 into 100, that is $200. So what we are noticing here is that in this strategy, in this example, so basically we are buying that call option at $2. That is one option, as I said, is that you can buy. If it's a call option you are buying, you have the right to buy at in 100 shares of those company at that certain strike price. So that's why you will be paying $200 when you will be buying that call contract. But you see, you will be break even if the contract which you paid for this $200, if you can basically get towards that break-even point, in which from further up you can make more profits. So that's why in this case, if the stock price was trading at $50, so if it goes to $52, so you would reach a break-even, because the call option was trading at $2 in the when we bought the option. So this will be cleared much better if we look at this diagram about this graph, as you can see here. So you can see it clearly here that the long call here, that during a certain stock price which you bought it at, so at that point of time, and if the stock price goes up, you see, and you make money, but it has a limited downside risk. So if the stock price moves further down, so if it goes further down 95, 80, or even if it reaches 70, so but still you will have a loss of only minus 200. But the probability of making profit is lesser, because you are already you are investing in the option by giving a debit. That is, you're investing $200 in buying this option. So you're already in a loss. So if a stock price is at, let's say, what we know by the previous example, that is $50. So if it does not move to $52, then we are in a loss. So same goes for here. If it's at let's say around at 101, then it needs to move at 103. We have not done the calculations about this thing, but in rough sense you can understand that it needs to move to a certain amount of the investment of the call option which you bought it at, in order to reach break even. Otherwise, you see, you will meet a loss because of the initial investment. So that's the thing, you have a limited downside, but you have a maximum possibility of making profits of if it goes on the upper side. So that is unlimited. So that's why, as I said before, here as you can see what we discussed here, so the maximum risk is limited. So as we discussed here, that is $200 by that example, that is the maximum risk, but the maximum gain can be a lot, even if it goes the stock price which was trading at $50. So if it goes at 150, so that's a pretty bullish assumption, which is clearly doesn't happen that way, but let's say it happens. So you will obviously gain from that point. But you see, because already we are already in a net debit position, so already you're paying for that option. So basically that's why you will have a loss. So you will have a loss in the upfront. So because of this loss, what really happens, your probability of your profits gets lesser, because you see within a certain period of time all the options become worthless if it does not move towards let's say a certain point, and if it means expiry. So that's why it needs to move in this sense of the call option. The stock price needs to move above that certain break even in order to make profits. So when you're buying an option, basically the out of the money option needs to become towards in the money to be profitable. So that's the thing. So I'll just show you how in Thinkorswim platform you can basically buy an option, as you can see here. So this is a trading platform. So I'll just analyze now. It's trading at 295. So let us calculate if the option so we buy a strike price of, let's say, at the money, that is at 295, and we analyze it. So we buying this option, as you can see here. So when we realize the break even is at 301.9. so what really one can see from here, I'll just check it as one option, that is 100 shares, as you can see here. So we are paying 6.95 per per stock, that is, so if you're taking into 100, that is $695. So you're paying $695 so for this option. So as you're already paying $695 so basically per stock, as you can see, it needs to be $6.95 above the strike price which we aimed at, that is 295. So I'll explain it again. So as we see here, so the stock price is trading at 295. As I said here, we are taking the strike price. So as it is trading at 6.95, as you can see the option here, the stock so the option price is trading at 6.95 for that particular strike. So basically one can say that it needs to be above 295 plus 6.95 to be profitable. So 295 plus 6.95, which we are trading at, so we will reach at around 301.95 approximately. Now we'll see, I'll just show you how in this risk analysis graph we can look into this, that this is really happening. So as you can see here, around this level, if you can see here, 301.9, almost that level. So this is the zero level, this is the zero level, this is the break even, right? This is the break even. So this level, let us concentrate here. As you can see here, it's around 301.9, almost there. So you'll reach your break even. So as you can see here, you might be confused between these lines, that is the blue line and the pinkish line. So what is the difference? That is the blue line is for at the expiry. So during the time what happens to the prices of the options that is determined here, so whether you need to buy or sell. So in this case we have the right to buy. So basically, so that's the thing, and there are a lot more things involved. That's why, you know, the upper one, that pink one, as you can see here, there are a lot more Greeks involved in this, in which determines the price levels of the options. That's why this pink graph is for the options prices of that particular day, and the blue line is at expiry. So as I say, the downside risk is limited. So as you can see here, the downside risk is only this much, but you see the upside potential is unlimited. But you see the probability of going up continuously for stock, that is, the probability is less from one point of view. So different strategies needs to be other than options needs to be implemented, like the fundamentals, the macros, so in order to understand. So basically this is the break-even point, and from there onwards you make a profit. So this is what is call option, which you can buy in the platform. Now we discuss about time value decay of an option price. So basically we need to imagine the investment, that is an option which we are buying, not really shorting, that is we are buying that option. Okay, so whenever we are buying an option, so whether it is call or put, so we need to think about what happens as an investment. Think it like you have a bucket and there is water inside it. So what happens here is that slowly the bucket, you know, there is little drops of water, it comes out, there is a small hole in the bucket, and what happens, the buckets what you call small droplets, like, you know, it goes down. So same way the option value slowly it goes down. Okay, but when towards the expiration, you know, the expiration date is approaching, as you can see here, expiration date is approaching, then towards near the expiry, the acceleration of, you know, the decaying of the option price takes place. That means the investment amount which you have put in, it decays quite a lot. As you can see the graph, the value, let's say whatever it is at, it is it goes and then suddenly it goes down to zero. So that's the acceleration, how it works. So due to different parameters, which is what it happens. So what we really need to understand right now, that is called time value of decay of an option price. So whatever investment you are buying on, if the strategy it doesn't work out, so slowly that investment which you are putting it out, so it goes towards zero. So that is a demerit when it comes to, you know, when you are in debit. So instead of when you are in the credit, it's you are going the reverse way, that is like vice versa. That is, in the case of credit, slowly towards the expiration, your profits are more, or the decay as it goes down by for the option buyers. So for the option writers, that is the sellers, it gets towards their more positive, that is they have acceleration profits. So that is now what you could understand here. What we really need to understand here in this graph is that what we are saying is it's more on option buyers. So slowly the option price goes down, and towards the expiration, that is the expiry date, the option value deteriorates, that it decays quite a lot, the acceleration takes place. So that's the thing. Moving on towards long put, it is just same as long call, but it is just the opposite. So what we discussed in long call is that when the option price, or when the strike price, when the stock price goes above the strike price, you make a profit. Same here, if you take a strike price, if let's say particular company stock is trading at $100, if it goes, let's say a strike price of that, and if it goes to $90, that's the share price goes to $90, you make a money out of it, you make a profit out of it. So that's why if from 100 to 90, if it's going down, you are making money. So what it is a bearish strategy. Okay, so that's the thing. So it is very simple, it is nothing so complicated. So that's why basically what we can understand, it is a directional bet, it's a bearish strategy, it's simple. And as I said, it's just a reverse way of, you can say, about a call option, that where you're making money on the downside. So when the share price is going down, you're making money. So that's why what we can say, as it is almost the same graph but the reverse way, so we can say the max risk is what do you call, limited. Okay, just like that. So max gain is also limited. Why is it limited? But because, like, see, the stock price, even if it falls down, it falls down to 0, you see, and it cannot go negative, it cannot go negative. So that's why basically the max gain is also limited. So that's the thing. If the stock price could have gone below, which it doesn't go, if it goes below, then it would have been unlimited. But you see, the lowest it can go is towards 0, so max gain is limited on the put option. So this is also a net debit, that is upfront costs are taken here. So when you're buying an investment that is on the put option, so you are spending money, that is, there is upfront cost to it, that is net debit takes place. So that is in respective to expiration date. So let us understand this by looking at this. So what is the break even? As you can see here, price of underlying security equal to strike price minus the price of option which you paid for. So profit calculations for maximum side, as you can see, limited only in the sense that the stock can only go to 0, as we discussed. Okay, profit is made when the price of underlying security is less than the strike price minus the option price which you paid. So that is what it is, that is of the profit. Profit per option owned is strike price minus price of underlying security minus the price of option. So that is your profits per option. So hope you could understand by looking at the call option. It's just the opposite way of looking the perspective. So now for the risk calculation, as you can see, maximum loss is limited to the premium paid, that is a debit, that net debit. Maximum loss is made when price of underlying security is greater than or equal to strike price. As you can see here, it's almost the opposite, as you can see here. So when the share price goes down, so you are making profit. So the share price, that is when it goes down, you're making profit. So you are in this loss period here if the share price moves up, but as you can see, it's having a limited risk, so it doesn't go more down. But in case of shares, what really happens is that, let's say you're taking around this level, so it goes down, or around this level it goes down. So that risk is there. Okay, so that's the thing. So this is in case of shares, but in options, that is the blue line, in this put options, basically, which we are buying a long put, what happens if the stock price goes down, you make money out of it, and if it stays below at whatever price, if it goes down, it doesn't really, it stagnates around this level, and that is your maximum, that is a max loss. So I could tell you how to buy that in Thinkorswim platform. As you can see here, if you go here, so what is the put option here? Put options are here, the right side, right? So what we really need to buy is we need to buy out of the money. What is out of the money here for the put options? That is below 295, or you can take at the money also, that is at 295, and you can trade, or you can trade at 290. I think that is your out of the money, as you can see here, and we can trade, and we can trade by 1 second. we can trade this. So it's just the opposite, as you can see here, like in the call option, but in put option it's the different, that is it goes reverse. So as I mentioned here, there is limited risk here, limited reward here, but like as you can see, it's almost like unlimited reward around the other side, because if you are having profits, that is still zero. So still, if it goes to zero, you're making a lot more money out of it. But it doesn't happen that way, but still, as you can see, the risk to reward ratio is a lot more. But as you see, as you are giving upfront capital, like investment, like a debit, so basically like in call option, same in put option, if you're buying a put option, you may give upfront cost. That's why your break even is at a lower price of the strike price. That's why the stock price needs to go down in order to be profitable, just like in long call, where it needs to go up in order to be profitable, otherwise it is not. So that's the thing. And there's limited downside about this, as I discussed about in this put option.